Hi everyone, $19 trillion. That's how much Goldman Sachs says AI stocks are overvalued right now. While retail investors are celebrating their tech gains, something quiet is happening behind the scenes. Institutional money is rotating, not selling, just repositioning. And the next 18 months will separate those who saw this coming from those who didn't. The CEO of Goldman Sachs stood on stage in Hong Kong and dropped a warning that sent shockwaves through global markets. Expect a 10% to 20% market pullback in the next 2 years. Morgan Stanley CEO Ted Pick agreed immediately on the same panel. Markets dropped within hours of these statements. But what they didn't explain in that carefully worded speech is where sophisticated investors are actually moving their capital right now. Goldman ran the math on AI valuations, and what they discovered should concern anyone holding concentrated tech positions. Companies have added $19 trillion in market value since ChatGPT launched in late 2022. But when their analysis calculated what AI could realistically deliver to the global economy over the next decade, they found something genuinely shocking. The baseline estimate for actual economic value creation, only $8 trillion. The upper limit under the most optimistic assumptions possible, exactly $19 trillion, which means the market has already priced in the absolute best case scenario with zero room for error or disappointment. Get this, over 80% of recent market gains came from AI-related companies. When one sector carries the entire market, that's not healthy diversification. That's concentration risk masquerading as a bull market. And institutional investors recognize the difference between momentum and sustainable value creation. Meanwhile, a silent rotation has begun that most retail investors are completely missing. Defensive sectors have outperformed cyclical stocks by 13 percentage points recently. Healthcare companies, consumer staples, utility providers, the boring businesses that people ignore at dinner parties and skip over in investment forums. But institutional money is systematically flooding into these names, while retail investors chase the next AI momentum play. Smart investors follow the smart money, not the loud money. Which brings us to SCHD, and why this specific ETF deserves your serious attention right now. This fund has underperformed tech-heavy indexes for 2 years straight. It's sitting in the bottom quarter of its category by recent performance metrics, and that's exactly why sophisticated dividend investors are getting genuinely excited about current valuations. While growth investors party and post screenshots of their Nvidia gains on social media, value investors are quietly accumulating what could be the most undervalued quality dividend fund in the entire market. SCHD currently yields 3.8%, more than triple the S&P 500's 1.2% yield, but yield alone doesn't tell the complete story here. This fund holds 103 battle-tested companies with minimum 10-year consecutive dividend payment track records. These aren't speculative plays or companies riding temporary trends. We're talking about established businesses like Amgen, AbbVie, and Cisco Systems. Cash printing machines that survived the 2008 financial crisis, the 2020 pandemic crash, and every significant downturn in between. But SCHD isn't just any dividend fund throwing darts at high-yield stocks. It systematically screens on 4 critical fundamental factors: cash flow to debt ratio, return on equity, dividend yield, and 5-year dividend growth rate. This rigorous methodology automatically filters out weak companies with unsustainable payout ratios and keeps only businesses with fortress balance sheets and proven ability to grow distributions through complete economic cycles. The type of companies that don't just survive market downturns, they acquire weakened competitors during crashes and emerge significantly stronger. Consider the current market environment and what it's signaling. Tech stocks trade at 23 times forward earnings right now. Only the dot-com bubble showed this level of optimism embedded in valuations. But here's the critical difference from the year 2000. Unlike the dot-com era, today's tech giants actually generate massive profits. Nvidia isn't pets.com, burning cash with no viable business model. Microsoft and Amazon built real, dominant businesses with actual earnings, power, and sustainable competitive advantages. So this isn't a traditional bubble ready to burst catastrophically. It's something more nuanced and potentially more dangerous for concentrated portfolios. It's a market priced for absolute perfection where any earnings disappointment, any slowdown in AI infrastructure spending, or any indication that returns won't justify the massive capital investments triggers immediate selling pressure. When stocks are priced for perfection, gravity eventually wins. Meanwhile, value stocks trade one full standard deviation below their historical premium versus the S&P 500. Translation: quality dividend-paying companies are effectively on clearance sale. Vanguard recently published their 10-year forward projection showing U.S. value stocks potentially returning 5% to 7% annually, while growth stocks might deliver only 1 to 3%. When one of the world's largest asset managers tells you value could dramatically outpace growth over the next decade, that's not speculation. That's mathematical probability based on current valuation spreads. The Federal Reserve has already cut interest rates twice, with additional cuts likely coming throughout the next year. Cheap money boosts consumer spending and corporate borrowing in the short term, which benefits the overall economy. Long-term consequences, we're looking at inflation accelerating significantly. Money printing throughout history always ends the same way. Your cash loses purchasing power while asset prices inflate. That's exactly why you need investments that generate real income and appreciate alongside inflation rather than assets whose entire value depends on optimistic future growth expectations. Wealthy investors aren't dumping equities entirely. That would be the amateur panic move. They're systematically diversifying across different asset classes that preserve and grow value during various economic conditions. Real estate benefits as lower interest rates spark renewed housing demand. Commodities like gold just posted exceptional performance, though some natural cooling after such gains is expected. Bitcoin continues its evolution as potential digital store of value, and quality dividend stocks provide that steady, growing income stream regardless of whether the broader market goes up, sideways, or temporarily down. SCHD fits perfectly into this diversified investment strategy. It provides concentrated exposure to recession-resistant businesses that sell products and services people actually need, regardless of economic conditions. Energy infrastructure, healthcare services, consumer staples, these aren't exciting growth stories that finance YouTubers create viral content about. They are proven compounders that pay you consistently while you wait for proper market recognition. The fund has averaged over 11% annual return since launching in October 2011, and it's currently trading below its typical historical valuation metrics. The margin of safety becomes crystal clear when you analyze this setup objectively. Buying quality companies at reasonable prices with sustainable growing dividends means you're not betting everything on the next AI breakthrough or hoping some speculative startup becomes the next Tesla. You're systematically acquiring established businesses that already prove they can generate consistent cash flow through multiple complete economic cycles. Smart portfolio allocation requires intelligent balance that works across multiple realistic future scenarios. Maintain some growth exposure because AI and technology innovation aren't disappearing from the investment landscape, but avoid concentrating 100% of your capital in high-flying tech stocks hoping for continued miracles. Add defensive positions that pay reliable dividends backed by strong balance sheets that can weather inevitable storms. Include some international exposure since Goldman projects emerging markets could return over 10% annually, while the US delivers only 6.5%. And hold real assets that protect purchasing power when money printing inevitably accelerates inflation. Most investors make one critical psychological mistake, thinking they must predict the future perfectly to succeed financially. Wrong approach entirely. You need intelligent positioning that works across multiple realistic outcomes without requiring perfect foresight. Tech continues its incredible run. Your growth positions capture those gains. A significant rotation into value finally begins. Your defensive plays outperform while others scramble to adjust. Inflation strikes harder than economists expect. Your real assets and dividend growers protect wealth. SCHD specifically solves the income challenge that's approaching. If the S&P 500 delivers only 6.5% annually, as Goldman Sachs predicts, that's 1.2% dividend yield suddenly becoming a much more significant component of your total return equation. But when you're capturing 3.8% from SCHD, you're locked in over half your expected return through dividends alone, regardless of price volatility. And those dividends grow over time because the fund specifically requires companies to demonstrate a track record of increasing payments. The rotation is happening, whether you notice it or not. Defensive sectors already outperform cyclicals by 13 percentage points. Institutional investors are systematically loading quality dividend payers, while retail investors chase whatever meme stock is trending. In 18 months, one group will calmly explain how they positioned correctly. The other group will desperately ask what happened. So comment below right now what percentage of your portfolio is in defensive positions, and are you positioned for both scenarios? Continued tech dominance or a rotation to value? Because the next 2 years will test everyone's strategy. Make sure yours survives both outcomes. This content is for educational purposes only and not financial advice. All investing carries risk. Past performance doesn't guarantee future results. Consult a qualified financial advisor before making investment decisions. Smash that like button, share with someone who needs this, and subscribe for real market insights. Here's to protecting your wealth and investing smart. Profitable investing.